Most people will retire broke, not because they didn't earn enough, because they spent every single dollar they made. Here's the numbers that should terrify you. More than half of Americans cannot cover a $1,000 emergency. Not broke people, not people on minimum wage, regular working people with jobs, with mortgages, with decent salaries. They earn it, they spend it, and then they do it all again the next month. And the wild part is, there's a stupidly simple, easy fix. One that requires less money than most people spend on subscriptions they forgot they had. But almost nobody does it. And by the end of this video, you're going to understand exactly why that is, and why the ones who do get quietly, almost boringly rich. Let's set the scene. You're not a hedge fund manager, you're not getting a 6-figure bonus, and you're definitely not inheriting anything. You're a normal person working a normal job, trying to figure out if there's a version of your future that doesn't involve working until you physically can't anymore. That's who this is for. And the number we're working with today is $100 a month. Not £1,000, not $500, just $100. That's less than most people spend eating out every month. Less than a lot of people spend on takeaway coffees. $100. £100, euros, pick your currency. Now here's the first thing you need to understand before we go any further. This isn't a get rich quick story. It's the opposite of that. This is a story about getting rich slowly, deliberately, and in a way that requires almost no skill whatsoever. Anyone can do it. And I know it might sound a little bit underwhelming, but just stay with me for a second. Because by the time we get to the maths, your brain is going to do something it doesn't usually do when someone says the word investing. It's going to actually care. So let's start with a question that nobody wants to answer honestly. Where does your money go? Not theoretically, not your budget on a paper, actually in practice. Like, where does it go? For most people, the answer is everywhere and nowhere useful. There's a cycle that almost all working adults are stuck in, and most of them don't even know they're in it. You earn money, you pay bills, you buy things that make life feel comfortable, you get to the end of the month with less than you expected, and you promise yourself next month will be different. A phrase I like to use is there's too much month at the end of the money, and then repeat. Economists have a name for it though. It's called lifestyle inflation. Every time your income goes up, your spending goes up with it. You get a raise, you get a nicer car, you move to a bigger apartment, bigger house, you upgrade the holiday, and the gap between what you earn and what you keep stays exactly the same. And this isn't a discipline failure. It's not a character flaw. It's what the entire consumer economy is built to do to you. Every app, every subscription, every one-click checkout is designed to make you feel like spending is frictionless. Saving, on the other hand, always feels like work. And here's the cruel irony of this. The people trapped in that cycle aren't necessarily bad with money. They're just not doing one thing. Real quick, if you're enjoying this, I break down market news every day in my free newsletter with exactly how to trade it, and you can get a glimpse at my live portfolio. Link is in the description, or visit dailybullrun.com. Now back to the video. They're not paying themselves first. That's it. That's the whole secret. Every pound, every dollar, every cent that comes in, they pay everyone else first. The landlord, the energy company, the grocery store, Netflix, Deliveroo, Amazon, and whatever's left, which usually isn't much, goes to them. The fix is to just reverse that order. But here's where most people get stuck. They hear pay yourself first and think, okay, but I have nothing left to save. And that might be true, but probably not in the way that you think. Because in a minute, we're going to look at exactly where you can find that $100. And for most people, it's already there. It's just invisible. So let's do something that school almost never did. Let's actually run the numbers. $100 a month. That's $1,200 a year. Over 40 years, you've put in $48,000 of your own money. That's not a super impressive money. You'd know people who have spent more than that on cars. But here's where it gets a little bit strange. At an historical average return of around 8% per year, that $48,000 doesn't end up being worth $48,000. It doesn't end up being worth $100,000 or $200,000. It actually ends up being worth over $350,000. You put in $48,000 and you walk away with more than $350,000. And if you use the S&P 500's historical average of closer to 10%, that number climbs past $500,000 from $100 a month. And here's the part that makes it genuinely mind-bending. Of that $350,000, only about $48,000 came from you. The rest, over $300,000, came from compound growth. You didn't earn it, you didn't work for it, you didn't trade for it. The market did all the heavy lifting while you just went about your life. And that's what compound interest actually means. Not the textbook definition, the real world, your future bank account definition. Your money makes money. And then that money makes money. And then the pattern keeps going. And it accelerates and gets faster every single year. The graph doesn't look like a straight line going up though. It looks like a hockey stick. Flat for years, then suddenly steep, then near vertical. And the only thing you have to do is not get off. And here's something nobody talks about. The maths only works if you actually start. And most people don't start, not because they don't want to, but because of a very specific set of excuses that feel completely reasonable in the moment. So we need to talk about those excuses, because one of them might be yours right now. I don't have $100 to spare. That's probably the most common objection, and it's the one we're going to destroy right away. Let's start with the cut side. Not budgeting in the miserable track every penny way, just one honest audit. Go to your bank statement right now, this week, and look at the last 30 days of outgoings. Almost everyone finds something there that's going to surprise them. A subscription they forgot about, a streaming service they haven't opened in 4 months, a gym membership for a gym they haven't visited since the twice they did it in January. And they're not going to be huge amounts individually, but they'll all add up. For example, the average person in the UK has around 6 subscription services running at any given time. The average American has even more, and most of them are just forgotten about and not used. So that's your first pool of money. Then there's eating out. I hate to sound like a boomer, but you've got takeaways, coffees. Not saying never do it. I'm just saying that most people have no idea how much they're actually spending on it until they look. Cut the stuff that's invisible to you, the stuff that doesn't even make you happy anymore, the mindless spends. Most people find $50, $100 doing this without even feeling it. And there's a second route that might actually be more powerful. Instead of cutting your budget, let's try and earn more. Freelancing, selling stuff you don't use, weekend work, whatever your skills let you do. Not permanently, doesn't have to be forever, but just enough to get some momentum. Because here's a secret about starting an investment habit. The first $100 is the hardest. The second is easier. By the time you've been doing it for 6 months, it starts to feel weird when you don't. A bit like brushing your teeth. And ideally, you want to do both. Cut something and pick up something. The $100 stops being a sacrifice and starts being a non-negotiable. And then when you get really good at it, you can automate it. This is probably the most important tactical decision of the entire video. Set up a standing order, or a direct debit, or an automatic transfer. Call it whatever you want in your country. The money leaves your account the same day your salary hits. You never see it. You never decide whether to move it this month. You never wait until after Christmas or start in January. It just happens. Because the single biggest threat to your financial future isn't market crashes. It's not inflation. It's you in a weak moment deciding that the timing isn't right. Automation removes you from the equation, and that's exactly what you want. Now about those market crashes I just mentioned, because we're about to get to the part of this conversation that determines whether any of this actually works for you long term, and it's the most important part people get completely backwards. There are 2 failure modes for this strategy. 2 ways that people take a near guaranteed path to wealth and turn it into nothing. And you need to know both of them. Failure mode 1, never starting. This sounds obvious. Of course, you know you should start, but the excuse isn't, I don't want to invest. The excuse is timing. I'll wait until I'm more stable. I'll wait until my debt is cleared. I'll wait until I understand it better. I'll start in January. Here's what every single one of those statements is actually doing. They're spending time, the one resource that makes this whole thing work for you. Every month you wait, you're not just delaying, you're reducing the final number permanently. Because compound growth is front-loaded in time. The early years count disproportionately. Someone who starts at 25 and invests for 40 years ends up with dramatically more than someone who starts at 35 and invests for 30 years, even if the 35-year-old contributes more money per month. So time is the cheat code, and every excuse burns it. Failure mode 2 is quitting during a downturn. So this one's a little more subtle because it feels rational when you're in it. The market drops 20%. Your portfolio goes from 15,000 to 12,000. You've lost £3,000 or dollars on paper in your account, and you can see it, it's in red. And every instinct you have says get out, stop the bleeding, and just wait until the market recovers. But here's what's actually happening in the moment. You're not losing money, you're buying the same assets at a 20% discount. When the market is down, your $100 that month buys more shares than it did when the market was up. So the volatility isn't your enemy, it becomes a feature. It's what generates the long-term returns. The people who got wiped out in 2008 were the people who sold at the bottom and never came back. The people who quietly kept investing through it, they came out the other side with portfolios that looked almost identical to where they would have been anyway. Both failure modes come down to one thing: emotions overriding process. The strategy is boring by design. Boring means sustainable, boring means consistent, boring means it actually works. The moment you start making active decisions like trying to time the market, waiting for the right moment, optimizing the entry point, that's the moment strategies stop working. And your job isn't to be clever, it's just to be consistent. And those are completely different things, and I'd rather just be consistent. There's one more piece to this, something that almost nobody talks about when they explain compound growth. And it's the psychology shift that happens once the balance starts to grow. Because the numbers don't just change your account, they change your behavior, but in a very specific way. Something happens when your investment balance hits a number that feels real to you. Not a few hundred, maybe a few thousand. Suddenly, it's not abstract anymore. You start checking it, but not obsessively, but you do notice it. The number keeps growing, even in weeks that you didn't do anything. That's the first time that compound growth will become emotionally real to you rather than just mathematically theoretical. And once you feel it, the behavior shifts. You start redirecting windfalls. A tax refund comes in, old you would have spent it, new you thinks, what happens if I put it in and compound a little more? Your bonus arrives, old you would have upgraded something, new you splits it. A raise kicks in, old you would have expanded the lifestyle, new you bumps up the monthly contributions. Not all of it, you don't have to live like a monk, but the gap between what you earn and what you invest, which started at $100 a month, quietly and almost accidentally will start to widen. This is the real compounding effect nobody puts in the maths. Not just your money compounding, your behavior compounding. You're not the same person at year 5 as you were at year 1. The discipline that felt like a sacrifice at the start has just become your default behavior. Your financial identity will shift. You're no longer someone who's trying to save. You're someone who saves, present tense, without thinking. That is a bigger shift than any market return, and it's available to literally anyone who starts. So here's what we covered. More than half of people can't cover a $1,000 emergency. Not because they're poor, because of a cycle that nobody breaks by accident. $100 a month, consistently invested over 40 years at historical market returns, turns $48,000 of your own money into over $350,000. You don't need to time the market. You don't need to pick stocks. You don't need to be clever. You need to start. Automate it. Leave it alone. Cut what you've stopped noticing, or earn a bit more, or do both. Survive the downturns without selling, because the downturns are where the long-term returns come in. And watch the behavior compound alongside the money. That's the whole strategy. It's boring, it's obvious, it's been documented in every personal finance book ever written, and yet the majority of people read or watch something like this, nod, feel a temporary motivation, and go back to the same cycle. Because the barrier isn't knowledge. It's the 10 minutes it takes to actually open an account and set up the transfer. That's the only thing standing between the version of you watching this and the version of you that's quietly, completely unbothered about retirement. So let's remember where we started. More than half of people can't cover a $1,000 emergency. You don't have to be one of them. If you want to understand exactly where to put that $100 once you've got it, check out some more videos or subscribe to my free daily newsletter at dailybullrun.com.